Hey traders, this is Blake Morrow with Trader Summit. With me today, it must be Friday because I've got Jim Welsh from Macro Tides with us. How you doing, Jim?
I'm doing good. Thankfully, it is a Friday.
It is, and we've got so much to talk about. What a busy week. I mean, we start off with CPI this week, and what do you make of the high CPI readings? I mean, the dollar, strengthened. Well, I mean, maybe that's not the only reason why it's strengthened, but let's just start off with CPI. What do you make about the high CPI read here?
Well, my expectation was that it would get close to 8. We might actually see an 8. We just missed it, obviously, by a 1/10. The reality is, like, with gas prices doing what they've done so far in the month of March, when we get the March CPI, probably around April 10th, there's a really, really good chance it'll print an 8 handle. So again, it's not really new news because it was pretty easy to know that that's what was coming. But it's still a big print. And to me, again, where I think I look about this, Blake, is people talking about high energy prices hurting consumer spending. And yes, it does on the low end. But I think the bigger issue is when people turn on their TV and we see what's going on in Ukraine. And then you go to the grocery store, the gas station, and just this feeling that, wait a second, it feels like things are spinning out of control. I think consumer spending is going to react probably more to the images of war than the actual increase in gas prices. But I do think that raises the risk of surely more of a slowdown in the second quarter in terms of the GDP.
Yeah, I was going to say, so what do you think's going to, I mean, it's discretionary consumer spending. It's really going to get hit, right, Jim?
Yep. Yeah, absolutely. Yeah. And again, if you're in the bottom 20% of wage earners, energy and food makes up a larger share of your income pie than it mess up the income strata. So some of at the bottom, people are going to do it out of necessity. Above that, it's like it's an inconvenience. But I just think the images and everything that's going on in the world makes it a normal human reaction is to pull back. And I think that will get translated into a broader slowdown in terms of consumer spending.
I'm gonna tell you a little personal for me. I actually enjoy going. It sounds a little silly. I enjoy going to the grocery store myself since I do work from home. I trade from home. I do these broadcasts, these interviews from home. It's like an excuse for me to get out of the house. But the fact of the matter is, I've seen what we spend normally. I've seen it increase quite a bit. So when people got to cut out X, to pay for Y, it's got to have some sort of impact moving forward, I would think. So it's going to be really interesting to see, if these high, I mean, I know commodities have been a little stretched here, might even be a little bit too stretched, but that persistent high inflationary pressure from commodities have to eventually weigh on consumer spending, I would think.
Yes, it will.
Yeah. So, well, that's not the only thing that happened this week. What else happened this week was the ECB. We had the ECB actually meet, and guess what? The euro actually reversed right at its breakdown point, right near 111. It was a really big deal, but also before that, and I'm going to bring up a chart that you brought here for us today. Before that, early this week, the euro, or actually we could say it closed last week. We closed really close to this long-term trend line. Tell us a little bit about what you're seeing here with this euro, and I'm assuming this is not just the euro dollar. This might be the euro contract, the 6C. Tell us what we're looking at here.
This is the euro cash.
Okay.
Going back to 2016, there was a low in January of 2017. That's on the far left of the chart. Intersects with a low that took place in 2000, I think 18 or 19. I don't have my glasses on, right? So you're 100% right. Tag that trend line. It bounced. I think that the surprise was that the ECB sounded more hawkish than most people expected, given what's happening with inflation. But that's being primarily driven by energy in Europe. So to me, what this implies is this is, I think, an intermediate low at a minimum, and a rally back towards the 114, 115 is going to come, I think, over the next 2 to 4 months, maybe a little bit longer. If you look at the bottom panel, it's the RSI. It's a momentum indicator. And as the euro is making lower lows, you can see how the RSI was making higher lows. Classic divergence. So to me, I think this says two things. The euro is near a low. the dollar's near a high. And I was looking for the dollar to trade up to near 100 back last summer, last fall, after it had bottomed in May, June. To me, the target was somewhere between 99 and 100, and we got there over the last week. So to me, the pieces are falling in place for a high in the dollar, a low in the euro, because I think people were surprised by the ECB's hawkishness when really they were expecting far more dovishness.
All right. Well, when you say classic divergence on relative strength, that doesn't guarantee a low, does it?
No, absolutely. You need confirmation of a reversal on the charts, because you can look on the left-hand side, 2018, and you can see the RSI kept making higher lows and the euro kept trending down. So you need a price reversal. This is where some moving averages can be helpful, like a 21-day moving average. I use a 5 and 13-day moving average, so that when the 5-day gets above the 13 exponential moving average, that again helps identify price reversals. This just, to me, like this says the potential's there, because you got a big trend line that just got tagged. RSI divergence, now you need to see price action confirm it. I guess I'm pretty confident that will happen in coming weeks.
All right. Well, thanks for bringing that chart to our attention. Now, one of the charts that you also talked about, because that'll parlay us right into next week. Next week's a big week with the Fed. Big inflation prints. I'm not sure if how worried they are about. Well, they're probably worried a lot about the inflation expectations that's happening around the world because of the Russia-Ukraine situation, especially in Europe. But that's not us, right? That's not us. But the rest of the world is a little worried right now because we have stocks that are higher and volatility is up. And this chart that you brought here is showing that volatility is really strong. So what do you make of this as we go into next week with the Fed?
Okay, I think the Fed and Powell, especially during his press conference, they're going to raise by 25 basis points. They're going to mention downside risk, obviously, from Ukraine war. They're going to talk about inflation, the persistence of it, and so forth. I think Powell, as he did in his testimony a week and a half ago in front of Congress, opened the door to, well, we're not going to do 50 basis points in March, but it may be required at future meetings at some point in time. I think they're going to keep that door open, Blake. So that's what the markets have to contend with, is with everything else that's going on. We've got monetary policy that's going to gradually get more restrictive. As I've said for months, going from 0 to 75 basis points is not going to have much of an impact on the economy. So that's the easy lift. And that's why I think the Fed is definitely going to do that. In terms of the Vix chart, what you can see is over the last year, whenever we had a decline, the VIX would spike up for very brief periods of time, 3, 4, 5, 6 days, something like that, and then immediately reverse. What we can see since early January is we had a spike, we had a pullback, and then you see this grind higher. And to me, that is completely different character relative to what we've seen the prior 12 months. It reflects that we do have two big reasons why investors are a little bit more reluctant to buy the dip and why they may be more inclined to sell. Obviously, Ukraine war, monetary policy. I think there's a chance that we will see a spike above that green line. My anticipation, we'll talk about the S&P chart in more detail in a minute, but I think there's a chance that we will see a spike in volatility above that green line. The trigger will come if and when the S&P closes below 4,200 again. So to me, this just says that we're in for a longer period of higher volatility. Maybe it's stating the obvious, but when you see a graphic like this, it kind of, confirms those, that outlook.
Yeah. So when you're now, Jim, we've talked months past, and you'd mentioned the Fed's going to front load rates, and does that mean that the Fed's going to could they possibly raise a half a basis point right now? And really, that would obviously kick up volatility. Or front loading to you means they're going to try to do them all, at the beginning of this year. But now, some expectations are that rates are going to rise, 6, 7 times still, even after everything that we've been through for the remainder of the year. What are your thoughts there?
Well, they're not doing 50 basis points in March, but Powell took that off the table when he testified in Congress, so they're not going to reverse that. They will telegraph when a 50 basis points is coming, with speeches and so forth. That's why I think the May meeting is a definite possibility. In terms of 6 or 7 rate hikes, I'm still not quite in that camp. I still believe the Fed is going to raise rates, in my opinion, at the next 3 to 4 meetings into not just May, but also June and possibly July. I think the world could look very much different in terms of how the economy is performing. We'll see some relief, I think, on inflation by then. So I'm not ready to go to that 6 and 7 rate hike scenario quite yet, Blake.
Okay. All right. Well, then let's talk about how the markets might react to, next week and maybe even the weeks ahead. So here you got your S&P chart. What are we looking at here?
Well, basically, we saw the S&P spike below the 4223. That was the January 24th low, which was the expectation. Got to 4115, rebounded, had another decline this past week to 4158. You can see it 3 ways up, in terms of the rebound up to 4299. Clearly 3 waves. Then you have this pullback. I think there's the potential that this is an A up, B down to 4210, and a quality because it rallied 141 points from 4158 to 4299. You had 141 points to 4210. You get 4350. I think that is possible, but I continue to believe that we're going to see another drop that carries the S&P below 4,200. We had one day where it closed below 4,200. It was 4,170, I think. I think if you go down there again, we're going to see kind of a washout. One of the things I noted in last Monday's weekly technical review was that despite the decline, we have yet to see a single 90% down day, meaning that if the S&P, if the New York Stock Exchange on a billion share day, 900 million shares would be down volume. Hasn't come even close to that. So a lot of times, and given what we've been dealing with and facing, to me, to have some kind of a capitulation washout day, I think is the probability of that is pretty high.
So you're still, then that means you're still in the camp that we can trade below those lows at 4115 back down to 4,000 before it's all said and done.
Yes. Yeah.
All right.
Yeah. It's kind of like, why are people going to die? Are we going to see a V-shaped rebound here? I don't think so. You would need a complete shift in monetary policy. Well, the only thing that would cause that is if the economy is far weaker than expected, liquidity starts to become a problem so that financial conditions tighten. Well, one of the things that contributes to that is a decline in the stock market. So if you're going to get to relief from the Fed, which I think is extraordinarily unlikely, you're going to need a fairly big hit to the stock market and or evidence that things are starting to tighten up within the banking system. Neither one of those things are really there yet. And the Ukraine war, I don't believe Putin is leaving Ukraine. I just don't think that's it. Anybody who thinks that these peace talks or anything are going to actually yield anything meaningful, I think it's just extraordinarily naive.
Well, then we're going to leave it at that. And I'm going to try to be naive for the weekend. How about that? Let's just try to be positive going into this weekend, Jim. That's all I want. I want a nice, peaceful, positive peace talks, ceasefire. Anyway, I'm with you. I'm not sure if we're going to get it, but let's hope the best for the people of Ukraine, and let's hope we get some sort of de-escalation of the current situation. But Jim, I was like hearing your thoughts, and I know other traders do as well. So how do they find out more? If I'm a trader, how do I find out more about you? Yeah.
Macrotides.com, or if you'd like to receive last week's Monday's weekly technical review, shoot me an email, Jim Welsh Macro at Gmail. I got an email this morning, or a couple of days ago, pardon me, somebody who responded, because I think I offered the same thing last week. He said, "Hey, I listened to what you did. I made $7,000 on yesterday's opening. Thank you very much."
Wow,
so
that's awesome.
Adjusted portfolios after reading that piece. So, those are the kind of things that's really pretty wonderful to hear.
That is. All right, Jim. Well, if you guys want to find out more about Jim, make sure you do give him a thumbs up here. If you're watching him on YouTube, subscribe to our channel so you don't miss any of our Friday interviews that we do right here. And also Make sure you follow him on, he puts out some of his content on Traders Summit. So Jim, thank you so much for being part of our community. Have a great weekend, and we'll see you next week.
And let's just carry good thoughts throughout the weekend.
Sounds great. Bye-bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.